Welcome to the Physician's Guide to Financial Wellness, the podcast dedicated to helping physicians in Michigan turn their professional success into financial success while enjoying life along the way. And now, here are your hosts, Andrew Mushbaugh and Trent DeBruin.
Hi, everyone, and welcome to another episode of the Physician's Guide to Financial Wellness. This is Trent DeBruin, and I'm joined, as always, by my co-host, Andrew Mushbaugh. And today we're going to talk about an increasingly common investment option in employer retirement plans, like 401ks and 403bs, which is target date investment funds. Now, some of you may already be familiar with target date funds and might even own them yourself, while for others, this may be the first time you've ever heard of them. But either way, what we'll do is start by providing some background, explain some of the positives, transition to some of the negatives, then wrap up by sharing our overall perspective on target date funds and what people or situations they are and aren't best for. So, Andrew, I don't need to worry about you choosing a 2025 target date retirement fund, right?
Nope. If anything, it'd be a 2065 fund.
Love it. I think we're on the same page there. Well, why don't you kick things off by explaining what exactly target date funds are?
Sure. So target date funds are investment funds, either in the form of a mutual fund or an ETF, that get more conservative over time by automatically decreasing their exposure to stocks and increasing their exposure to bonds as time passes. The reason they're called target date funds is because each fund has a date or year associated with it, and you choose the one that corresponds with the year you expect to retire. For example, if you're just starting out your career as an attending, you might choose a target date 2055 fund. Whereas if you're later in your career and are on the verge of retirement, you might choose a target date 2025 fund. And the idea behind target date funds and how they work aligns with one of the principles of investing we've discussed on the podcast several times in the past, which is matching your investment allocation or risk with the time horizon you're investing for. The concept here is that a longer investment time horizon lends itself to a more aggressive investment mix, more stocks and less bonds, since you have plenty of time ahead to ride out the ups and downs of the stock market while capturing the higher expected long-term returns of stocks. While conversely, the shorter the time horizon, the more conservative the investment mix, since you generally want less portfolio volatility and less risk of a temporary decline if you need to use the money within a shorter time period. So with target date funds, they automate this process of shifting your allocation over time by starting off more aggressive when you're younger, then gradually becoming more conservative as you get older and move closer to retirement. There are many different investment companies that offer target date funds, and the exact mix of stocks and bonds for a given retirement date varies by company. But just to give an example using Vanguard, the Vanguard 2055 target date fund is currently 90% stocks and 10% bonds, whereas the 2025 fund is currently 57% stocks and 43% bonds. The adjustment process also varies by company, but it typically happens in 5-year increments, and the way these funds work is that they are actually a fund of underlying funds. So the target date fund is adjusting its mix of the underlying funds over time. For example, the Vanguard Target 2055 fund owns 4 underlying Vanguard funds: a U.S. stock fund, an international stock fund, a U.S. bond fund, and an international bond fund. And over time, the fund will reduce the amount invested in the 2 stock funds and increase the amount invested in the 2 bond funds. And eventually, within 5 years of the target retirement date, we'll add a 3rd bond fund as well. Stepping back and bigger picture, target date funds were created in the early 1990s, but they didn't really start to gain traction until the early 2000s, when there was some change in legislation that introduced automatic enrollment for 401ks and placed more liability on companies to offer appropriate investment options for their employees. The idea was that most individual investors aren't well equipped to pick out the right investment allocation for themselves from a list of 20 or more investment options. So by offering a target date fund, that would be a good option for the people who aren't able to choose the right custom mix or who aren't going to check their accounts over time. By selecting the target date fund, they would end up having a well-diversified investment portfolio whose risk adjusts over time as they get older. And in that sense, it would likely produce a better outcome than people just randomly choosing their funds. And in fact, many 401ks and 403b plans now have a feature where if you don't specifically choose your investments as a new participant, by default, you're automatically placed in a target date fund that corresponds to your expected retirement date at age 65. For example, this is the case for the 403b plans for most of the big health systems in our local area of Ann Arbor and Detroit. As a result of this feature, target date funds have become increasingly popular and common over the years, and as of 2020, more than half of 401k investors had all their 401k assets in target date funds, and more than 75% of all investors had at least some portion of their money, either retirement or non-retirement, invested in one. So these funds were essentially designed to solve the problem of 401k and 403b participants who are either automatically enrolled, then never check their accounts, or are enrolled but find it too overwhelming to choose their investments from all the different options. And since these two groups happen to represent a large percentage of the 401k and 403b investors out there, and because of the simplicity of target date funds, they've continued to increase in terms of their use and popularity. So that's some initial background on what target date funds are and how they work. And based on that initial explanation, you can probably already start to see some of the benefits and positive aspects of them. So Trent, why don't you dive into those in a little bit more detail?
Yeah, there are certainly many pros of target date funds, and the biggest one is simply their simplicity. There aren't many investment funds out there where you can invest in one fund and essentially set it and forget it without having to then monitor it or make any adjustments over the course of time as you move closer to retirement. Now, when we talk about some of the cons of target date funds, we'll explain why there are better options available, depending on people's investment expertise and ability to manage things themselves, or with the help of an advisor. But for the many people who aren't experts in investing and just want an easy way to invest their money that's not going to be bad for them, target date funds certainly check that box. Along similar lines, target date funds also provide excellent investment diversification. As we've discussed in prior episodes about investing, diversification is the idea of not putting all your eggs in one basket, and rather than owning a handful of stocks or bonds in one specific area of the market, instead diversifying your portfolio by owning thousands of stocks and/or bonds all across the globe. By doing this, you're able to spread out your risk and end up with an investment portfolio that's less volatile, but has the same or even better investment returns, which is why diversification is often referred to as the only free lunch in investing. As Andrew mentioned, a single target date fund actually owns several underlying investment funds, which in turn each owns hundreds of individual stocks or bonds. So by owning that one target date fund, you're able to achieve excellent diversification. A third benefit of target date funds, as alluded to, is that they automatically reduce the risk of your investments as you age. Now again, the way they do this is a bit crude and mechanical, which we'll elaborate on in a bit, but they do achieve that purpose of adjusting your risk profile over time as you get older and your investment time horizon shrinks. And going back to the idea of simplicity, the fact that they do this automatically without any effort required on your part is a big plus for people who aren't interested in proactively managing their investments and rebalancing them over time. A final positive of target date funds is if there's a situation where your employer's retirement plan either has a limited list of investment options or if the other funds you're able to choose from are mainly expensive, actively managed investment funds. In these scenarios, even if you have the knowledge and ability to pick your own investments, it can be difficult to build a cost-efficient and properly diversified portfolio. So if there's also a target date fund option, assuming it has a reasonable cost, that can potentially be your best bet for investing your money in that scenario. So as you can see, there are certainly a lot of pros for target date funds, and in general, their introduction has been a positive for investors, especially as the burden of investing for retirement has shifted over the years from the employer to the employee as we've moved from a pension-based retirement system to a self-directed one through 401ks and 403bs. And for many people, a target date fund may in fact be the best option and the best approach for them in terms of quote-unquote doing no harm during the years when they're working and accumulating money in their employer retirement accounts. However, there are also some major drawbacks to target date funds during the accumulation years, but even more so during the transition period to retirement and then ongoing in retirement. So Andrew, why don't you explain some of those?
Yeah, the biggest drawback of target date funds is that by using them, you give up control over your ability to choose and manage your investment risk. And in that sense, there's no personalization because it's just a cookie-cutter mechanical approach. And this makes sense because it's the other side of the coin of their simplicity benefit. There's a predetermined approach for what underlying investment funds will be owned by the target date fund and how or when the ratio of those investments will change. The reason we don't like this is because we don't believe your investments and investment allocation should be determined and adjusted by some arbitrary formula, but instead should be personalized to you and the specifics of your situation. For example, yes, you might be planning to retire at the same time as a larger group of people, but that doesn't mean your situation will be similar to the average of the group. You may have a different portfolio size, a different lifestyle, a different investment temperament, etc. All factors that would produce a different ability and or willingness to take on investment risk, and therefore a different investment mix and approach. To optimize things, your investment allocation and the way you adjust it over time should be set with intention and should be based on your unique situation, goals, and the trade-offs and risks you're willing to accept rather than mechanically. So in other words, one of the major downsides of target date funds is that they lack personalization because they force you to arbitrarily change your investment allocation over time simply because of your age and not because of your actual personal situation. Along with that lack of control comes another potential downside, specifically around the retirement transition, which is the risk of having your investment allocation automatically adjusted in the wrong direction at the wrong time. To elaborate, as you're moving into retirement, your target date fund will be getting more conservative by selling stocks and buying bonds. However, what happens if your retirement transition coincides with a big stock market pullback or a bear market, such as what we saw during the 2008 or 2009 financial crisis? This was a period when the U.S. stock market declined by more than 50% from peak to trough. So if you owned a target date fund with a retirement date during that time period, you would have been selling stocks at a loss as they were crashing and buying bonds to replace them, which is exactly the opposite of what you should have actually been doing if you were managing your investments with control over your investment allocation. If that was the case, you would have been rebalancing your portfolio in the opposite direction by selling bonds and buying more stocks to replace them when the stocks had fallen as a percentage of your portfolio and were temporarily on sale. Rebalancing in this way would have positioned you much better to capitalize on the subsequent rebound in the stock market and the recovery of stocks. So while from a bigger picture perspective, it generally makes sense to reduce your investment risk as you approach retirement, you don't want to just do it blindly and instead want to be smart about it based on what's actually going on in the world. And the 2008 and 2009 example is particularly dramatic, but the stock market pullbacks and bear markets are extremely common. In fact, the market experiences a temporary decline of 20% or more approximately once every 5 years. And periods like these are where the mechanical adjustment and loss of control that comes with target date funds can get you into big trouble and cost you a lot financially by removing your ability to be intentional and forcing you to buy or sell things at the wrong time. And this lack of ability to rebalance or control your investments isn't just relevant in retirement during the distribution phase. It's also relevant in the accumulation phase. As we've talked about in prior episodes on investing, when you're managing your investments in a customized way using a diversified portfolio, you'll likely have a mix of several different investment funds, each representing a different type of investment. U.S. stocks, developed international market stocks, real estate stocks, etc. Naturally, different investments will perform differently at any given time, and your actual investment allocation will drift away from your target allocation because of this. Well, when you're saving money to your account each month, each time you contribute money, one of the things we like to do is, rather than simply buying each fund in its target weight, we like to buy a little bit more of the funds that have relatively underperformed, and therefore have a weight below their target, and buy a little less of the funds that have already relatively outperformed, and therefore have a weight above their target. The relative performance of different investments tends to flip-flop depending on the time period, and the relatively underperforming investments in one period are often followed by the relatively outperforming investments in the next period. Therefore, by following this approach and rebalancing with new money coming in, you're able to quote-unquote buy low for the underperforming investments by buying a little more of them when they're on sale. However, if you're investing in a target date fund, you lose the ability to do this because those multiple different investments you own are all put into a single investment fund. And when you buy more of the fund, you're buying the underlying investments and whatever their set proportion is. So you lose this ability to rebalance your portfolio. So big picture, target date funds remove your ability to rebalance your portfolio intentionally. And this is important because rebalancing has been shown to improve your investment performance over time. A final downside of target date funds, which can make it more difficult to know exactly what you're getting into and what you're paying for it, is that they aren't uniform. As mentioned, there are many different investment companies that offer target date funds. However, there isn't a standard approach for what mix of stocks and bonds corresponds to a given retirement date. And even within the two categories of stocks and bonds, there isn't a standard in terms of what specific investments are held. Different companies have different definitions of what it means to be diversified or conservative at a particular age, and it's arbitrary by each company and how they do it. For example, if you look at the Target Date 2030 fund across 5 different fund companies, you'll see that each has its own mix of stocks and bonds. In bigger picture, each company also follows a different approach in terms of exactly how and when the investment mix adjusts over time as you get closer to and through that target retirement date. And while we talk about stocks and bonds being 2 general categories of investments held within each target date fund, the investment companies don't have a uniform definition of bonds or what constitutes the quote-unquote safe or conservative portion of their investment allocation. Some companies have more government bonds, while others have more corporate bonds. And some companies even hold cash and CDs as part of their safe exposure, which is much different than holding actual bonds. In addition to variability in the underlying investments and how the investment mix adjusts over time, there can also be significant difference in the cost of these funds. As of 2020, the average internal expense ratio, the amount the investment company charges to manage the fund, was around 0.5%. However, the range is dramatic as some companies, like Vanguard, charge closer to 0.1%, while others charge as high as 1.5%. Now, this difference in fees can be said of all ETFs and mutual funds, so it's not exclusive to target date funds, but since they're inherently passive and index-like investment vehicles, I think people sometimes assume that all of them are cheap, but that's not necessarily true. So overall, the key point to make here is to understand that there isn't a uniform or standard approach followed by target date funds. And because of that, if you're considering investing in one, it's really important to understand exactly how the fund you're considering is positioned now and how or when it's going to adjust over time.
All right, so we've gone through the list of pros and cons, and as you can see, there's certainly a case to be made for both sides. So what's our overall take on target date funds? Well, in general, we do think there are situations where they make sense for people. Not everyone needs to or wants to work with a financial advisor, and for the people who don't work with an advisor and don't have an interest in learning about investing and managing things themselves, target date funds can be a nice option because they make it possible to cheaply and easily self-direct your investments. This is especially true when you're earlier in your career and earlier in the accumulation phase of retirement savings, and the amounts in your 401k or 403b aren't as large. Yes, you're giving up the potential to do better, but if the alternative to using a target date fund is trying to pick among expensive actively managed funds or using the approach many people use with their 401ks or 403bs, where they invest equal amounts in each of the different investment options, you're going to be better off using a target date fund where you have a diversified portfolio whose risk adjusts over time. So in that sense, it can be a situation of doing no harm, or at the very least, minimizing the amount of potential harm done when compared to the other alternatives. There's also definite value to the idea of being able to set it and forget it, and for some people, the ease and convenience of this might more than offset the potential drawbacks that exist when comparing target date funds to the quote-unquote optimal approach. So that's one scenario where target date funds can make sense. Another one is 529 college savings plans. In these accounts, the dollar values tend to be much lower than they do for retirement accounts, so the stakes are lower, financially speaking, and the time horizon is shorter since you're likely investing for at most 18 years. Because of the smaller dollar values and shorter time horizon, some of the downsides of target date funds are reduced and their ease and convenience become even more relevant. So those are a couple scenarios where target date funds can make sense and can even be the best option for someone, but when do we not recommend them? Well, one situation is when you're either working with a financial advisor or have enough investment knowledge yourself that you can choose your own investment funds to build and manage a properly diversified portfolio that fits your unique situation. When this is the case, you're able to achieve the positive aspects of target date funds while at the same time maintaining control over your investment risk and allocation and your ability to manage and rebalance it according to your specific circumstances. So that's an obvious one, but a couple other scenarios where target date funds make us more nervous are, one, when you're later in the accumulation phase and account values are higher, and therefore the stakes are higher in terms of making sure things are managed correctly or optimized. And two, when you're either making the retirement transition or in the retirement/withdrawal phase. This is where it becomes even more important to have control over your ability to rebalance your portfolio and decide how to withdraw from your investments to fund your lifestyle, depending on what's going on in the market, what you're doing from a tax planning perspective, etc. So that's our overall perspective on target date funds and when they do and don't make sense. As we mentioned, target date funds have become increasingly common, and if you haven't come across them yet, you likely will at some point. So hopefully this discussion leaves you better equipped to understand them and make a decision about whether or not they're right for your situation. And just to give a quick recap of some of the key points we covered, number one, target date funds are investment funds whose risk, i.e. mix of stocks and bonds, adjusts automatically over time as you get closer to your target retirement date by increasing the exposure to bonds and decreasing the exposure to stocks. These funds have become the default investment option for many 401k and 403b plans. Number two, some of the key positives of target date funds include their simplicity, their diversification, and their ability to reduce risk as your investment time horizon shrinks. They allow people to manage their investments using a set it and forget it approach. Number three, while they do have many positives, they also have some drawbacks, the biggest ones being their cookie-cutter approach in terms of not being customized to your unique situation and removing your ability to control and rebalance your investments. This can cause problems by producing the wrong investment allocation for your situation and by forcing suboptimal adjustments to your investments during certain market scenarios. And lastly, number four, situations where target date funds can be a good option include the accumulation phase of retirement savings, especially earlier in your career, for people with no interest, desire, or ability to manage their investments, and 529 college savings plans, where the account balances and investment time horizon tend to be smaller. On the flip side, target date funds often don't make sense if you have the skill to be able to choose and manage your own investments, or if you work with an advisor who can help you do that. And they become an issue during the retirement transition and in the decumulation phase of retirement, where you're withdrawing from your investments. Well, thank you everyone for joining us for another episode of the show. If you want to check out the show notes, you can find them at the podcast page of our website, mdwmllc.com/podcast. And if you have thoughts to share or questions you'd like to have answered, you're welcome to email us at info@mdwmllc.com. Take care, everyone, and we'll look forward to talking to you again soon.
Want even more ideas, tools, and resources on how to make smart financial decisions? Check out the resources section of MD Wealth Management's website at mdwmllc.com, where you'll find additional knowledge and insight from Michigan physicians, including a blog, ebook, and one-page guides. While there, you can also schedule a 15-minute conversation with Andrew and Trent to learn more about what it means to work with the firm and how they serve physicians. If you've enjoyed the content, please leave a review on iTunes and share with your friends and colleagues. Thanks so much for listening. Andrew Mushbaugh and Trent DeBruin are certified financial planners, principals, and co-founders of MD Wealth Management, a registered investment advisory firm in the state of Michigan. All opinions shared in the show are for general information and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future returns. Please consult with your legal advisor, your tax advisor, or your financial advisor before making any decisions.